In light of recent events surrounding Venezuela and its oil industry, it is important to understand their full cycle or break-even cost of oil to assess the relative competitiveness with other jurisdictions. Since capital typically flows to regions with lower costs, the question is, will producers invest in the exploration, development, and production of Venezuelan oil? Venezuela produces heavy oil, similar to Canada's oil sands bitumen, which requires special processes for production, transportation, and refining. Not all refineries can process heavy oil. Those that can are mainly located on the U.S. Gulf Coast, but also in China. So what is the full cycle cost of Venezuelan oil? To begin, public information on Venezuelan oil costs is very limited, and costs will vary depending on geological conditions, extraction methods, oil properties, and proximity to export terminals. Between 1995 and 1998, when Venezuelan oil production reached its peak, the break-even price was estimated between $15 and $30 per barrel in the producing basin. This would be highly competitive today. However, since then, full-cycle costs and break-even prices have increased significantly due to maturity of the fields, aging infrastructure, lack of qualified workforce, and international sanctions. Incorrys estimated the full cycle cost of oil in Venezuela based on comparable heavy oil production in eastern Alberta. Here are a few assumptions. Venezuela's organic hydrocarbons law sets royalties and extraction taxes at 33% of the value of each barrel sold. The basis differential to WTI is assumed to be $7 per barrel. The full cycle cost depends on 30-day new well initial productivity, IP, and ranges from $39 per barrel for IP above 900 barrels per day to $46 per barrel for IP between 300 and 600 barrels per day. For comparison, the full cycle cost of Canadian oil sands in-situ production is approximately $42 per barrel. Note that this full cycle cost assessment does not include a risk premium, which for Venezuela is significantly higher than for Canada. Overall, Canadian oil sands remain competitive with Venezuelan oil, although how much oil is available across different IP ranges in Venezuela is uncertain. Going forward, the cost of Venezuelan oil could decline through higher IPs, a narrower basis differential, and lower royalties. However, increasing production would require significant capital spending, which would raise the cost of capital and increase finding and development costs. Additionally, labor costs would most likely increase, leading to higher costs across other full-cycle cost components.